Hi class, this video is going to run through chapter 14 of our textbook, which is the first chapter on unit 4, and it covers bad and doubtful debts. Remember, we are using the Macmillan textbook, and you'll find all this information on pages 279 to 283. What are our learning intentions to achieve in this topic? There are a number of them. By the end of this video, I hope that you can do a number of things. I hope that you are able to distinguish between the recording a bad debt and a doubtful debt. So you're going to need to be able to distinguish them and define them. You will be able to record the recognition of a bad debt and also the creation of a doubtful debt. And you'll be able to adjust the allowance for doubtful debts account when debts are written off. If we work hard throughout this unit, you'll be able to do a number of things, as I said, define bad debts and doubtful debts, and be able to record a number of transactions in general journals for bad and doubtful debts. So let's have a think about credit transactions, and particularly credit transactions when we are making a sale. This topic is all about what happens and the risks of providing credit, making sales on credit. Let's do some quick revision. We know that when we make a credit sale, this is recognized as revenue. Not only is it revenue, it is also an asset, and we report the accounts receivable as this asset. So we have a credit sale that results in revenue, and this creates an asset called accounts receivable, and we report this in our balance sheet. Specifically in our current assets section of our balance sheet, because we know accounts receivable, our credit customers must pay us back as soon as possible. But what is the issue of providing credit? I want you to pause this video and have a think for yourself. What is the risk of making sales on credit? Hopefully you came up with this big obvious risk. When trading businesses provide goods on credit, there is always a chance that some of these accounts receivable customers will not settle their debts, will not be able to pay us back what they owe us. So we as accountants need to think through how we're going to account for this risk. And this comes down to why we do doubtful debts and this concept of faithful representation. Given there is no certainty that all of the amounts owing will be collected, there are some questions. Should we recognize all of our credit sales? Or should we just ignore this possibility that we will not be able to collect them? So we have a dilemma. How are we going to record our credit sales? How do we do it and still keep our value of faithful representation, actually showing what is going to happen? And these questions show the need for us to have what we know as an allowance for doubtful debts. So let's think about and let's come to the definitions of doubtful debt or allowance for doubtful debt and bad debts. There are two terms that you need to know, and they have very different meanings. When I'm talking about an allowance for doubtful debt, I am recognizing that some amounts owing by the accounts receivable may never be collected. I am making an allowance for some debts of my accounts receivable. We need to think of this allowance for doubtful debts as a negative asset. What does this mean? This is a prediction that once a business has traded for a period of time, that some of our credit customers will not be able to pay us back. It is a prediction, but once a business has traded for a period of time, they generally become really good at reliably predicting this non-payment. So allowance for doubtful debts is a negative asset, so it reduces our assets by the amount that we predict will not pay us back. This is different to our bad debts, which are an expense account created when a customer, our accounts receivable, is written off as irrecoverable. We recognize that we will never collect the amount owing. So the accounts receivable will become known as a bad debt. So make sure you understand these terms and use them correctly in exams. But I suspect a lot of us are still looking at this going, I don't really understand what's going on. As always, examples make it clearer in accounting. But I want you to really understand, allowance for doubtful debts is when we recognise that some of our credit customers will not pay us back, so we reduce our asset. When they don't pay us back, we have what's called a bad debt expense. So what I want you to do is have a think of a business example. And I want you to think of an example of that business that would be a doubtful debt and a bad debt. So you can really solidify what the difference is between the two. And once you've done that, hopefully it's starting to get an understanding that there is a few steps to this process of recognizing the risk of credit transactions. The first step is that we will establish an allowance for doubtful debt. And the second step is we will write off a credit customer when it actually becomes a bad debt. So first step, we make a prediction of what percentage or how much of our accounts receivable won't pay us back. And the second step is when someone doesn't pay us back, we write it off as a bad debt expense. So let's get to an example. How do we record bad and allowance for doubtful debts? Well, the first thing we have to do is establish an allowance for doubtful debts. This is usually based on a percentage of credit sales. For example, in this example, credit sales for the year for this business were $100,000, and in management experience, 5% of credit sales normally go bad. That normally 5% of our sales don't get paid back. So we need to record an allowance for doubtful debts. So how much of this $100,000 will we not be receiving? The prediction is 5% or $5,000. We need to make a general journal transaction to record this information to faithfully represent our credit transaction. And this is what our general journal transaction will look like. I've put in the date of June 30. It doesn't have that there, but we're going to raise a bad debt expense of $5,000 and create an allowance for doubtful debts of $5,000. The bad debt expense is a debit because an expense that increases our debits. An allowance for doubtful debts is a negative asset. We are reducing our assets going down is a credit. Some sort of narration, such as adjusting entry to establish an allowance for doubtful debts, is perfectly acceptable. But what I really want you to understand is this general journal has created an expense and reduced our assets, and this makes sense when we think that of the $100,000 asset, we're actually not going to receive 5% of it. Let's go into this a bit more detail. Once we have raised this allowance for doubtful debts, we must understand how this impacts our balance sheet. This allowance for doubtful debts, as I mentioned, is a negative asset. It's going to reduce our assets. We report this in our current asset section of our balance sheet, and we will report still our accounts receivable at $100,000. So the amount owing by accounts receivable is still reported, $100,000. But the value for allowance for doubtful debts is deducted from this figure. We will write now a new line item in our balance sheet, less allowance for doubtful debts, $5,000. And this faithfully represents how much we expect to receive from accounts receivable in the future. We expect to really only receive $95,000 of our credit customers owing, so hence we only have an accounts receivable of $95,000. This is why we are now faithfully representing that information. So, what is the impact of this general journal entry on our accounting equation, which you will remember is assets equals liabilities plus owner's equity? We know that this double entries will always have a twofold effect on the reports. to make sure our accounting equation balances. Our twofold effect is first, it creates a bad debt expense. An expense will decrease net profit. Expenses go in our income statement in other expenses, and this will reduce our owner's equity. The current assets of our business are also decreased. So our assets will go down and our owner's equity will go down. So in terms of our table, increase, decrease, no effect. Assets decrease because our allowance for bad debts increases, which reduces net accounts receivable. No change to liabilities. We haven't talked about liabilities at all in this video. And our owner's equity decreases because we have an expense that increases, which reduces profit, and this is reported in our owner's equity section of our balance sheet. So this is our impact to our accounting equation. So what happens when we actually identify a customer that won't pay us back? Because up until now, we haven't talked about specific customers. We've just recognized that there will be some debts that won't be paid back. So we've raised an allowance for doubtful debts, which is a prediction. We now need to come to step 2, where we write off a credit customer when they actually become a bad debt. We know a customer can't pay us back. So how do we do this? We actually have to write off the account, and let's consider this example. On 31st of March, and the dates might be slightly not relevant, we're informed that one of our credit customers, ConJob, has been declared bankrupt. Not an uncommon thing for a credit customer to happen. He is not able to pay any of the money owing to the business, and the debt that ConJob owed us was $4,400, which included GST of $400. How are we going to report this? The general journal entry required would be as follows. I think often it is the easiest one to think about here is the credit. We are going to reduce our accounts receivable C job, remembering we always split it out by customer, by $4,400. Why? Because they will no longer pay us back that. They can't. Our debits must equal that, and the first debit is our GST clearing. It mentions specifically that we had $400 of GST, and as you can see from the arrow, as the business will usually collect GST charged and then give it to the ATO, we must cancel this so we don't overpay the ATO. We no longer are going to collect this GST. So anything we collect from in terms of GST must go to the government. We will no longer collect this, so we are going to reduce the liability of our GST being a debit. Secondly, we are going to reduce or increase our allowance for doubtful debts. The remainder of the debt is debited against the balance of allowance for doubtful debts. We thought the business had allowed for some bad debts to occur, and they have. So we don't create another bad debt. Remember, we've already created a bad debt expense of $5,000. We don't want to double count, so we're just going to move some things around. We are going to recognize that the customer is no longer able to pay us back the $4,400, and we're going to reduce the amount of allowance for doubtful debts. We allowed for $5,000 as a credit. We are now going to reduce this by $4,000, and we have $1,000 left over. How does this look in our general ledgers? In our allowance for doubtful debts, as you can see here, and again the dates are off, I think, July 1, we recorded a balance of $5,000. We predicted $5,000 of our credit customers would not pay us back. If we look at our general journal, we have a debit for allowance of doubtful debts, which recognizes $4,000 of that prediction has come true because of C-Job. So if C-Job was the only bad debt experienced in this reporting period, management would now know that the original estimate of the allowance was $1,000 too high. What does this mean? We thought $5,000 of our worth of customers would not be able to pay us back, and it turned out only $4,000 when it wasn't able to be paid back. So we are $1,000 too high. What happens next? So let's think through the process that we've done. The process so far has been as follows. We do an allowance for doubtful debts is established, and bad debts are written off against the allowance, and we've stopped. The next step, though, is we also have $1,000 too high, and we need to make a new estimate of what our allowance should be. The next time period comes, we have to think how much will not be paid back in this period. So let's say, after looking at this, we recognise only 4% of our customers weren't paying us back, $4,000 of $100,000, and in this new period, we have $110,000 of sales. So we now think of the $110,000 of sales we've made, 4% won't pay us back. So our allowance for doubtful debts should now be raised to $4,400. 4% of $110,000 is $4,400. So we need to do an adjustment to our allowance for doubtful debts to adjust it up again for our new prediction. We now need to raise it so it now equals $4,000. So we would make our ledger updated to look like this. You can see that I have done some balancing here, and hopefully you can see an error. But I have recognised that I want my new balance, July 1, for allowance for doubtful debts to be $4,400. On the bottom right, you can see July 1 on the credit side, balance $4,400. I have then hence put the balance at the end of the month on the debit side and totaled each up. Now, hopefully you recognize there is an issue. My credits don't equal 8,400. I have missed something, but this is where I need to get to. So what is going to be the credit that balances the right-hand side? To complete the process of adjusting the allowance of doubtful debts, a new bad debt expense must be recorded in the usual fashion, so the account is balanced, and so we report and record a new bad debt expense for the new period. What will that number be? If we look at our incomplete ledger, hopefully you can recognize that that should be 3,400 to add to the 5,000 to get to a balanced ledger. Here we are. It now balances out with a credit on the allowance for doubtful debts of 3,400 with a cross-reference of bad debts, which means we're doing a debit to bad debts. This will look like a general journal entry like this. Bad debt expense of 3,400 as a debit, an expense that has increased being a debit, and we're going to reduce our assets by a further 3,400 to recognise we have an allowance for doubtful debts of 4,400. If we know our allowance for doubtful debts is 4,400, why have we only done a credit for 3,400? We get to recognise that the bad debts entry in the new period is $1,000 less because the previous period it was too high. So we adjust it to make it accurate for the new period, regardless whether the estimate in previous periods was too high or low. So we lost out on our bad debts in our first income statement because they were overstated, and we will be rewarded in our new period with expenses being reduced. So it is a complicated process, arguably the most complicated part of Year 12 accounting. So one last complication to make it even more complicated, sometimes and often a bankrupt accounts receivable customers will be able to pay back a little bit of it. It's very uncommon that a customer goes totally bankrupt and can't pay some of it. So instead of C job owing $4,400 and not being able to pay any of it, like we've done in our example, they might be able to pay 25 cents in the dollar. They can pay back 25% of what they owe. So what they can actually pay us back is $1,100, and then we have to make a bad debt of the rest. Therefore, the amount not paid would be $3,300, and the journal entry will look something like this. Our cash will go up by $1,100. We will have an allowance for doubtful debts, and we will reduce our GST clearing by $300 and recognize that this removes all of what C job owes us. This is where it starts to get complicated, and we will do lots of examples in class to get comfortable with this. And this is where you are able to start to really show your accounting knowledge. And can you pause this question and complete this test your learning example? Once you've done that, hopefully you have achieved an understanding of a really complicated process of recording when our credit customers can't pay us back, and you've been able to achieve the learning intentions. Well done for watching this video. I have no doubt that you have found this complicated, because it is. This is a topic that requires lots of practice and lots of thinking. Now's the time to start working hard.